Good afternoon. This is Sean Golding with Golding and Golding. As we head deeper into tax season and expanding upon our recent presentation, our expat tax guide that we had updated for 2024, a common question we get is, do U.S. expats living overseas have to pay U.S. tax? Do they have to report their income? Do they have to report their foreign assets, accounts, and investments? Let's go through the basics. So, from a baseline perspective, the United States is one of only a few countries that follow something called citizenship-based taxation on worldwide income for anyone who's considered a U.S. person. So what that means is, if you're a U.S. citizen, lawful permanent resident, or foreign national who meets a substantial presence test, you are taxed on your worldwide income, and you are required to report your foreign accounts, assets, investments to the U.S. government. Most other countries is something called residence-based taxation. If you live in that country for a significant amount of time, normally more than 6 months, then too you are taxed on your worldwide income. But the U.S. does it is different. So let's say Joe is a U.S. citizen. He moves overseas. He earns all of his income from foreign sources. The majority of his assets are foreign. Maybe he has some rental property, some bank accounts, some investment accounts, some pension. None of that is U.S. source, but he is still required to report his worldwide income and the assets to the U.S. government, just as if he was living in the United States. There's no distinction from a 1040 versus 1040 NR perspective. Now, just because a person lives overseas and they have and they're taxed by the U.S., that doesn't mean that they will have what's called a net effective tax liability. They may have foreign tax credits that can be used to offset their income. They may qualify for the foreign earned income exclusion to exclude upwards of $120,000 of earned income, along with certain housing deductions. They may qualify for a treaty election. They may qualify for like the closer connection exception to substantial presence. There's lots of ways around it. But from a baseline perspective, they're required to file. And one very important reason why U.S. expats have to stay in tax compliance is because over the past few years, the U.S. government has significantly increased passport denial and revocation, especially if you only have one passport. You don't want to be living overseas and get that revoked or denied when you try to renew it. So another important thing to consider is whether someone is an expat or an expatriate, right? Looking at the technicalities of the distinction between those two words, when someone says, are you an expat? A U.S. expat lives abroad the majority of the time, but they still have their U.S. person status. So a U.S. citizen lives in a foreign country, but they're still a U.S. citizen. They're considered an expat. They still pay tax on their worldwide income and report their global assets. When someone's an expatriate, that typically means they have formally renounced their U.S. citizenship or terminated their lawful permanent residence. They are no longer subject to U.S. tax on their worldwide income or having to report their assets. Instead, they're taxed on their U.S. sourced income. Instead of filing a Form 1040, like a U.S. person would, they file a Form 1040 NR non-resident because they are now a non-resident alien. It also impacts certain issues with like withholding, if they're a covered expatriate or not, whether they can reduce their withholding based on treaties, etc., etc. But the most important thing to consider is if you live overseas, excuse me, even a majority of the time, but you have not formally renounced or terminated your U.S. status, then you are still a U.S. person for tax purposes. You still file a Form 1040. But that doesn't mean you're going to owe tax. So let's look at some examples, right? Let's say Jane lives overseas. She's a U.S. citizen. She makes $120,000 a year earned income, and then she has $50,000 to $60,000 of passive income, but she pays 30% tax, right? Yes, she will file her U.S. tax return, and she will have some tax liability. But once she factors in the foreign earned income exclusion and her foreign tax credits, she may not have any. If she paid less foreign tax than she would have paid in the U.S., she may still owe some. If she paid the same amount, congratulations. If she overpaid, then she can carry it forward to use against other foreign income in future years. If a person is a U.S. person, normally a resident, and they live overseas in a treaty country, they may qualify to make a treaty election to be treated as a foreign person for tax purposes. In that type of situation, they would only be taxed on their U.S. sourced income. So with expats, it's normally citizens, and that's not typically available. But, from a tax perspective, even if you're a green card holder and you're living overseas, you may be considered an expat for tax purposes, right? You have citizenship in another country, but you're subject to U.S. tax on your worldwide income. So if you're living overseas, you're subject to those same rules as a citizen. You could be grouped together as a U.S. expat. But you may qualify for a treaty election if you can prove significant contacts, and there's different tests depending on the treaty. But if you qualify, then that's great. The other option is to formally renounce or terminate your U.S. status. Now, if you're a citizen or a long-term lawful permanent resident, you're considered an expatriate, and then you have to go down the long, winding hallway to determine, are you a covered expatriate? And if you're a covered expatriate, are you going to be subject to an exit tax? So it's very important to consider the exit tax implications before doing that. And one kind of tripwire to be aware of is that sometimes a person will learn after the fact that they can make a treaty election to be treated as a foreign person. They'll start filing Form 8833s. But if you do that after you're already a long-term lawful permanent resident, LTR, then that is the same as expatriating. And if you didn't plan properly, you may be hit with a significant exit tax, especially if you have a high amount of mark-to-market gains that have not been realized or possible ineligible deferred compensation like foreign pension, et cetera, et cetera. If this is all news to you, it's very common that it is. If you want to get into compliance, the IRS has developed various amnesty programs to safely assist you with doing so. It doesn't require quiet disclosure. You don't want to necessarily get yourself into any more trouble. Oftentimes, doing one of these programs is pretty straightforward and simple, especially if you're an expat and you qualify for the streamlined foreign offshore procedures. If you're willful, the only program available is the VDP, the Voluntary Disclosure Program. If you're non-willful, there's various programs available. They're the streamlined procedures, delinquency procedures, and reasonable cause. We have a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter and it's something that we handle here. Again, my name is Sean Golding with Golding Golding. Thank you for your time. Enjoy the rest of your day.